What if I told you the biggest mistake most homeowners make could cost them tens of thousands of dollars, and they never even see it coming? That's right. It's hiding quietly in your home insurance policy. But don't panic yet, because today, you're going to learn exactly how much home insurance you really need, and more importantly, how to stop overpaying for coverage you'll never use or underinsuring yourself and risking financial ruin. Stick with me, because by the end of this video, you'll know the one question most insurance agents hope you never ask. Number 1. Why too little or too much insurance hurts you? Let's start with the big question, why does it matter? Here's a simple story. Sarah bought her dream house in Texas. The house cost her $250,000. She figured she'd save some money and just get a policy covering $150,000. A storm ripped her roof clean off and damaged the structure. When she filed her claim, she was shocked to find out her payout was much less than the repair costs because her coverage didn't match the replacement cost of her home. On the other side, her neighbor Dave was paying for coverage well over $400,000, thinking more is better, but his house was only worth $250,000, meaning he was throwing away hundreds of dollars every year for nothing. That's the problem. Too little, you pay out of pocket when disaster strikes. Too much, you waste money. You need to find the sweet spot. Number 2. Understand replacement cost versus market value. Here's where most beginners trip up. They confuse the price they paid for the house with the amount it costs to rebuild it. Let me explain with an example. Imagine you bought a house for $300,000, but if a fire destroyed it completely, it might only cost $200,000 to rebuild it exactly as it was. That $200,000 is called the replacement cost. Market value includes the land and sometimes fluctuates because of the neighborhood or economy, but you don't need to insure the land. It's not going to burn down. So step 1, talk to your insurer about your home's replacement cost, not its market value. Many insurers even offer free tools to help calculate it. Number 3, don't forget about personal belongings. Here's another thing people forget, everything inside your house. Think of it this way. If you flipped your house upside down, everything that falls is considered personal property. TVs, furniture, clothes, computers, jewelry. Add it all up, it can easily hit $50,000 or more. A friend of mine, Jason, was shocked when a pipe burst in his apartment and he lost nearly all his electronics. He thought his landlord's insurance would cover it. Nope, he didn't have enough coverage for personal property, so go room by room. Estimate what it would cost to replace everything. Many policies cover between 50 to 70% of the dwelling coverage for personal property, but if you have expensive jewelry, art, or collectibles, you might need to buy extra riders for those. Number 4. The secret of liability coverage. Here's the part most homeowners overlook, liability. What if your dog bites a neighbor? Or a guest falls on your icy driveway and sues you? These things happen more often than you think. In fact, the Insurance Information Institute says the average dog bite claim costs around $50,000. Liability coverage protects you from these situations. Many policies come with $100,000 of liability coverage, but experts recommend at least $300,000. It barely raises your premium, but gives you much more peace of mind. Here's a quick example. A family in Florida got sued when their tree fell on a neighbor's car during a storm. The damages and legal fees added up to over $100,000. Their higher liability limit saved them from financial disaster. Number 5. The deductible dilemma. Let's talk about deductibles, the amount you pay out of pocket before your insurance kicks in. If you choose a higher deductible, your premiums go down. If you pick a lower deductible, your premiums go up. It's a bit of a gamble. For example, choosing a deductible of $500 might cost you $1,500 a year in premiums, while a $2,000 deductible could lower your premiums to just $1,200 a year. But remember, can you afford to pay that deductible if disaster strikes? Think about your emergency fund and pick a deductible you can realistically cover. Number 6. Special risks you might overlook. Here's where things get sneaky. What about floods, earthquakes, hurricanes? Most standard home insurance policies don't cover these. I had a client in Louisiana who didn't realize her home wasn't covered for floods. When Hurricane Ida hit, she was on the hook for over $80,000 in damages. So here's the rule. Check what natural disasters your area is prone to and consider extra policies if you're at risk. Flood insurance and earthquake insurance are separate, but they can save you from total loss. Number 7. Don't forget additional living expenses. Here's a scenario you might not have thought of. Your home is unlivable after a fire. Where do you stay? Most policies include something called additional living expenses, or ALE. It pays for hotel stays, meals, and even laundry while your home is being repaired. For example, one family in California was out of their house for 3 months after a wildfire. ALE covered their rental and meals, which came to more than $10,000. Check your policy to see how much ALE coverage you have. It's one of the most overlooked but life-saving parts of your insurance. Number 8. Review and update regularly. Your home isn't static. Why should your insurance be? I once knew a couple who renovated their kitchen and added a sunroom, spending over $50,000. But they forgot to tell their insurer. When they had a fire, their payout didn't cover the upgrades. Anytime you renovate, add valuables, or even see local construction costs rise, call your agent and update your policy. It only takes a few minutes, but it can save you from a giant financial headache later. Number 9. Watch out for actual cash value versus replacement cost policies. Here's a sneaky trick some insurers use. They offer you actual cash value policies, which deduct depreciation from your payout. For example, if your 10-year-old roof is damaged, they might only pay you what that old roof is worth today, which can be much less than what it costs to actually replace it. Instead, look for a replacement cost policy. It costs a bit more, but it pays you what it takes to replace your home or belongings at today's prices. Don't let depreciation eat your claim alive. Number 10. Consider inflation protection. Here's something most homeowners don't even think about. Inflation, building materials and labor costs rise over time. If you bought your policy 5 years ago for $200,000, but rebuilding now costs $250,000, you could be underinsured. Many insurers offer an inflation guard endorsement, which automatically adjusts your coverage to keep up with rising costs. For example, in areas where construction costs spiked after a natural disaster, people with inflation protection were fully covered while others paid out of pocket. Always ask if your policy includes this feature. Number 11. Beware of policy limits on high-value items. Even if your policy says you have $100,000 for personal property, certain items have limits. Jewelry, fine art, electronics, and firearms often have much lower individual caps. For example, most policies only cover jewelry up to $1,500 per item. If you own an engagement ring worth $6,000, you'd be seriously underprotected. You can buy special endorsements, called scheduling, to fully insure these high-value items. Take a full inventory and talk to your agent about covering your most valuable possessions. Number 12. Pay attention to exclusions. This one surprises a lot of people. Every policy has exclusions, things it doesn't cover. For example, mold damage, pest infestations, or certain types of water damage might not be included. One family discovered that their termite damage wasn't covered, and repairs cost them $15,000. Always read the fine print and ask your insurer to explain exclusions clearly. Knowing what's not covered helps you plan and budget for possible out-of-pocket costs. Number 13. Shop around every few years. Don't assume your current insurer is giving you the best deal forever. Rates change, discounts change, and competitors are always trying to win your business. One homeowner saved over $400 a year simply by getting 3 new quotes and switching to a company that offered better discounts for his security system. It's worth checking rates every 2 to 3 years. You might find you can increase coverage and still pay less than you do now. Number 14. Ask about discounts. Insurance companies offer all kinds of discounts, but they don't always advertise them. You can save for having smoke alarms, burglar alarms, a newer roof, or even being claims-free for several years. Some companies even give discounts if you bundle home and auto insurance. One homeowner / 20% off her premium just by installing a monitored security system. Always ask your agent about every available discount. You might be leaving money on the table. Number 15. The one question you must ask before buying. I promised you at the start there's one question most insurance agents hope you never ask. Here it is. Can you show me the full replacement cost estimate of my home and break it down by components? Why? Because it forces them to actually calculate the proper replacement cost. not just throw you a random number. You'd be surprised how often agents lowball coverage just to keep premiums low, but then you're underinsured. Insist on seeing the breakdown. It might include the square footage, cost per square foot in your area, and adjustments for special features. This one step alone can save you thousands later. So, how much home insurance do you really need? The right answer depends on your home's true replacement cost, your belongings, your risk tolerance, and the special risks in your area. But here's what you now know. Never guess, never assume, and never settle for whatever the agent suggests without asking the right questions. Now, I'd love to hear from you. What's the one thing about your home insurance that confuses you the most? Let me know in the comments below.